Now let's go into the 1 hour time frame so that you can see in real action how it would actually work on a low time frame. Pulling up the chart over here, you can see your price, right? It's been chopping up and down. This is the environment most people get taken out of the market. But the only reason for that is because they're not using the right strategy. When price moves sideways, you typically want to be range trading. And again, marking out our levels in a very, very simple way. You can see, you can mark out your zones. That is going to be your range high. That is going to be your range low. Price action comes into this zone over here, and that is going to be your mid-range. Remember the discount and premium analogy. So as price comes down here, we should be looking for opportunities to go long. So you can see the way that the wicks reacted. As price bounces off over there, you now have an invalidation point. You'll learn more about those invalidation levels, how to enter and exit trades in the future lesson where we cover stops, entries, and take profits. But let's continue with the exercise. We have our range now drawn out. Let's see what price does. Price is there pushing up, gets to the top side over there, rejects. As soon as that happened over here, that was a trade opportunity. I'm going a little bit fast. Let's drop the speed down and reverse it back slightly. So there we go. As soon as you get this candle, big push up, swing failure. What is a swing failure? Price failed to break out of that range. That is your confirmation. You now have a short trade. You take your tool, you enter into the short, your stop loss goes above that zone over there. You're looking to take the majority of your profit at the mid-range, but you can actually pull this tool all the way down to the bottom of the range, 50% of your profit taken there, let the rest run, and then you bring your stop into break even. Here's an example. Let's watch it play out. There you go. Price goes pretty much all the way down. Will it finish the job though? There we go. Price finishes the job. The short trade has completely played out to perfection. You're now looking to trade this in the opposite direction, right? So immediately after that, you're looking to potentially go long. Here is the long trade idea. Let's see if you get an entry. Stop goes below that wick over there. You can move your entry point towards this level, and then same thing, playing it back towards the top and allow price action to continue. There you go. Entered into the trade. Immediately you got into that trade and allow it to continue to play out. See what happens. Okay, price is still going. It's still running. Almost stopped out at this point. It's okay to be stopped out. You continue to leave the trade. There you go. Take profit 1 has been hit. Let's see if price action makes it to the very, very top of that range. But this is an example. You shorted it to the bottom side. You longed it to the top side. You're still in the trade. You've taken half your profits. You've now moved your stop loss at this point completely to break even. There should be no risk of a loss within this trade. And there you go. Full profits. The trade is complete. Price actions above, and immediately what do? You look to flip short again, and as you can see, you pretty much would have had that trade play out all the way back to the bottom. You guys get the idea. I'm not going to add in another short tool, but you would have shorted this right back to the bottom, and let's allow it to speed up a bit so we can finish that off. There we go. That's a complete trade. Now you're looking to potentially go long again, breaks back into the range, holds over there. That's exactly where price action is right now. As we speak, you'd be looking to go long and play it back to the top side. So here's an example. You had 3 trades within this one tiny little range over there. That was your next entry. Stop would have gone above there, shorting it all the way to the bottom of the range. What are your risk to reward ratios over here? Pretty good. This one is a 4.28 to 1 risk to reward ratio. This one over here, great risk to reward ratio as well. And then this one over here, we had a 2.3 to 1 risk to reward ratio. So both favorable. You remember from what you learned in the risk management section that that is a favorable risk to reward ratio. If you understand your hit rate, you can run a 1 to 3 risk to reward ratio, even a 1 to 2 risk to reward ratio every single trade, and you will still be profitable over time.